Hey, Kevin Brierton here, your no excuse lender, coming to you with your January 2026 mortgage market report and real estate report. Wanted to jump right in and show you what's going on in the market. Big headlines this end of the year in 2025. We had three Fed rate drops for the federal funds rate. That did end up lowering interest rates overall. And as you've watched other videos, likely we've actually seen as the Fed funds lower the rate, we actually saw interest rates actually go up a little bit. So that's why you see some bounciness, at the end of the year with rates. Now they have trickled down, which has been a good move overall, and it's helped the end of the year kind of increase some transactions, both purchase and refinance. Forecasts overall have been good. Everything's been somewhat in line. The actual home appreciation came in a little bit lower than expected based on Redfin analysis. Unemployment's been pretty rock solid. Like we haven't seen a big change in unemployment, which has been really good. Mortgage spreads have decreased. That is actually helping interest rates improve, even though rates haven't changed too much in the mortgage-backed security market. Mortgage rates have improved, so that has been helping us. Now, the 10-year Treasury is about where it has been forecasted by MBS Highway. A couple other places we watch has been right on line with this. Now, if we look at home appreciation, it's been cooling differently across different states. So across different states, Arizona here in Arizona, we've seen a little bit more cooling than other states, and it's all around inventory and what's going on with inventory. Inventory has been rebuilding gradually. So we had a big dip in the last couple of years of where the inventory levels were at, but it's been rebuilding. If you look at all these different colorful lines, that's all been the lines in the last couple of years where inventory was really low. Just not a lot of housing to choose from for buyers in the market. And it's been difficult. And that's what's been driving up prices and limiting options for buyers. But we finally have an increase in inventory, making it a little bit better, more stabilized market to buy in and sell, frankly, if you're buying and selling. We've really seen a steadier and stronger market ahead. And we're really not kind of off to a races by a crazy strong market, but it just needs to be slow and steady, which is very important. Affordability is improving modestly, and will continue to do it based in 2026 expectations, which has been a kind of a welcoming thing. We need affordability coming back in. When we look at rates, pricing, and wages, all of that goes into affordability. Interest rates overall, we're not going to see this crazy big decline yet, but we've seen a modest decline already, and we'll still see continued improvement here. And if we look at the things that are going to influence mortgage rates that we watch, is there are some targets and estimations that we're going to see, the 10-year Treasury around 3.9 or so this year. So a little bit dipped from where we're at right now in the low fours, about 4.2 to 4.3 for the 10-year Treasury. Hopefully we'll see some additional debt help depending on what's going on with the debt. And if we see some alleviation of how we're spending money and improving our debt loads, there's a couple other things here. Fed quantitative easing, if we can start buying some mortgage-backed securities and also limiting the supply and demand curve there, it's going to be important. I know the White House and Trump's talking about having Fannie Mae and Freddie Mac buy mortgage-backed securities, which will actually help interest rates in theory. That's the theory. Hopefully, they're also talking about bank deregulation to help interest rates ease. There's so much regulatory cost on banks, a lot of it rightfully so. But at the same time, that cost eats into mortgage interest rates and pushes mortgage interest rates up because of the cost of that. 10-year Treasury is hovering right in that range of about 4.2. They're estimating maybe 3.8, maybe dipping all the way down to 3.6, and that'll drive interest rates down. Mortgage rate forecasts from Fannie Mae all the way down. The average is sitting right around 6.17. Now, some rates are saying, some places are saying they're a little bit lower, a little bit higher. Some are anticipating the mortgage MBS Highway is estimating 5.7. So we'll see where it ends up being at, but this is a good trend. We're seeing interest rates moderate, but they dropped off that average. We saw over 2025, we saw an average of a rate of 6.6% on average throughout the year. And we've really seen that drop down, which has been really good for buyers and affordability. So we're going to start seeing more affordability and also income improve. The income is important because as we see rates come down, we see wages tick up just a little bit or not drop. That's going to be really helpful. The expectation of home prices moderating across the board. These are all your different categories of what we're looking at from Zillow, Redfin, Bank of America, the Mortgage Bankers Association. What they all look and estimate home price appreciation to be. So affordability is really set to continue to modestly improve in 2026, which is excellent. And rising income should outpace inflation, giving buyers a little bit more purchasing power. So if you're selling, this is good for you because your buyers can possibly buy what you're looking to sell. And if you're buying, this should help you afford the house you're looking for a little bit easier. Now, it's been a little bit harder to find a job after being let go. This has gotten a little bit harder. Nothing crazy, but it's getting slightly harder. So people are actually opting to stay in their job rather than leave because of this. Job openings continue to slow. So there's less job openings overall, which is making it harder to find a job after if you left the job. And then payrolls are weak, but not too weak that it's driving issues in the housing market yet. Unemployment forecast is around 4.8. Now we're still pretty in a pretty solid range that we kind of been sitting at just above 4% for a year and a half or so, but not anything too out of hand. And wages will grow or are expected to grow faster than home prices in 2026, which is helping the overall market kind of to stabilize, especially at the higher rates that we're seeing. And if they stay still consistently around high fives, low sixes, that wages are going to help the housing market because wages are expected to go up a little bit more than the home prices. Now, income's climbing faster than inflation as mortgage rates steady at a lower level, create a space for affordability to improve. And this is a welcome sight because if people are making more money and the housing prices are cheaper, and monthly basis, that could be a really good thing for housing and good thing for home buyers as overall. Looking at 2026, the direction is still up, even if the climb is steady rather than steep. Now we're continuing to improve here, and what we're seeing is life events, like they're saying here, is really the reason why more homeowners are nudged to move and do something, even though the rates might be sub 4%. There's really life events, death, divorce, having kids, upsizing, downsizing. That's what we're helping people with right now. We are seeing people that are moving really have a need to do it, or they've been just waiting and they want to get that right house. And they're like, you know what, I'm not going to continue to wait. Let's go ahead and do that. That's what we're seeing real time live on the streets here. Inventory is expected to rise in 2026. So we should have a more inventory, more options, more ability to negotiate because you have a little bit more inventory on the market for buyers, which has been really good overall. New construction will tick down slightly as estimated. So builders just aren't excited to go build a bunch of inventory and a bunch of houses because they're worried, what if things do slow? What are we going to do with all the inventory we have? Market remains undersupplied. So we have an average annual supply since 1990 of around 1,324,000 homes that need to be started, but we're still below that. We ticked up during the recent couple of years when rates went down, but we're still below what we need to really sustain the market and the household growth that we have. So at least partly due to the slowing pace of sales is slowing down. Some older homeowners are deciding it's time to downsize. So inventory will increase as people will finally decide, hey, you know what? I need to do something with this house. I can't wait around forever for interest rates. I need to do something with the house that I'm in. And looking ahead, expected a 2-speed market. Depending on where you're at, markets can vary a little bit depending on the inventory levels. It could be really good if you're leaving one area, let's say leaving the Midwest and moving to an area that's a little softer. It can really benefit you to make that move. So if you're thinking about making the move, and if you're in an area where there's lower inventory and you need to sell, and you're buying in a place where there's higher inventory and you could be able to get a deal, this could be a really good time to do that. Now, while mortgage rates and inventory will bring some buyers back, this will really be like a reset year they talk about, and not a rebound year. So just kind of resetting, things stabilizing. This is what we need, and it'll bring a better long-term market if we can stabilize this. Expected inventory, expected improvement in existing home sales. So home sales itself, if you're a realtor watching this, you should see more properties sell. So like we actually have more transactions, more opportunities to help people. So that's going to be important. Just the activity alone, freeing up some of that pent up demand and inventory. New home sales will tick up a little bit. It's expected to tick up a little bit. New home sales for projections as well. Total home sales are expected to rise, so including resale, new build, overall expected to go up a decent amount. Nothing crazy, but a little bit higher than we've seen this last 2 years. Buyers are benefiting from more inventory. So if you're a buyer out there, you should see more inventory, more affordability. While sellers are starting to kind of see these prices stabilize, and we all want a lot of money for our house, but that also creates other issues in the market overall. And we see a major opportunity for talking about expired and canceled listings. So if you're a seller watching this, understand that if you don't sell your house is going to become either an expired or canceled listing. So, and you're going to get calls from realtors going, hey, I could do X, Y, Z. And the reality is there's a flow that happens here where expired listings average days right now are about 36 days on national average is what I pulled from. If the house is relisted, the average sale time is 75 days. So you have to keep this in mind in the right pricing strategy. You're more likely to sell your house when you relist with a different agent. You're actually depending on what you're doing with your house, you got to decide, okay, if I relist, what is my strategy with the next agent I'm going to go with? Sellers who switch agents sell their house faster once back on the market. It's really, in my experience, it's going to be about price and how do you strategically make sure you're pricing it accurately up front to move it. I've seen usually within pricing strategy, you want to be within about 5% of what you actually think it's going to sell for, because this is something that agents will use to move your property. They may look like a superhero, but they might just price the home lower and a better market price than your friend did that you listed initially. And you wonder why they couldn't sell the house is because it was overpriced. So you want to make sure you're aware of your pricing, how you're moving it, what you're doing. It's very important. What you're doing. There's a lot of people there's so many expired listings coming up. This gives opportunity to agents. It also gives an opportunity to buyers. If your agents can find people that wanted to sell but couldn't sell, a lot of pent up demand to sell. There's a lot of delisted homes on the inventory right now. We have more homes that are being pulled off the market rather than selling than we did all the way back into 2016. I mean, we have a lot of houses right now being delisted, and they were for sale once and then taken off the market. Nearly half of all the delistings were purchased within the last 5 years. So if people bought in the last 5 years, maybe they don't love their house, they delisted it, and they're trying to sell. Maybe they're trying to sell for a really high price because they saw the market pop up, and then they weren't happy with it. So I think there's going to be a little bit of a right sizing, and understanding like we're not at the sky high prices that you saw maybe a couple houses sell at a certain time period. And there's just more moderation and realistic pricing going on right now. So if you found this helpful, please like or subscribe or follow. I try to bring valuable information every month and throughout the month with videos and content. Again, if you found it helpful, please like, subscribe,